Welcome to your first edition of Mad Markets for the week. Paul, welcome to the program. Great to have you in.
Yes.
So, would you say that markets are a leading indicator and that we're pricing in the future? Because essentially that's what we always do when markets slump. We know that something bad is about to happen. They're always forward looking. Are you comfortable that we've priced in the right future?
I'm not really comfortable with the current scenario because I think in the old days, by which I mean like 3 or 4 decades ago, the Fed did what it liked and nobody ever knew until years later what their agenda was. Economic data would come in pretty slowly, once they'd collated everything in the big ledger books. And then people would say, oh, look, inflation's up a bit, and then they'd decide what they were going to do in their business. Nowadays, not only does the information arrive like almost semi-real time, the delay in terms of gathering all these stats is very, very short. But the damn stock market has become the principal economic indicator. So like if the Dow is up 100 points, then the recession is not going to happen. If the Dow is down 200 points today, then it's like we're in big disaster.
And we have these daily assumptions essentially to try and explain what moved the markets up
it's totally
and
nuts.
down. And the truth is we do have a lot of economic flow and we have a lot of headlines that people respond to. But we speak mostly to long-term investors. So it's the traders that are to blame. Isn't that right?
Look, I'm not saying that it's a bad thing. All I'm just saying is that it's a bit crazy. So this year we know that we were one good session on the JSE away from being up for the year. And like literally 3 or 4 weeks ago, we were down at the lows of the year and it looked like we were going to fall off the edge of a cliff. So all I'm saying is you do need to suspend your judgment a little bit, but understand the market does move around a lot and understand that everybody's making decisions real time. I don't know whether it's a better world that we live in, but at least, you got to get with the frequency.
Paul, you can't tell me that you don't like down days because it gives you opportunity to buy, especially when you get new money coming in.
Exactly.
And then you can really outperform.
Different people do different things in the market that we know. Ourselves, what we do in a very modest and quiet fashion is invest people's savings for the future. So you're right, we do prefer down markets followed sharply by increasing markets.
Especially when you get the money today and then markets rally tomorrow.
There's always somebody to make happy with those kind of actions.
What's fascinating, and I was watching Greek television over the weekend, it's so dismal because we hear this negativity coming through there and everyone's worried and the austerity measures closing down businesses. And then in the other end, we're really happy that banks are going to take 60% haircuts and we're going to deal with the problem and austerity measures are going to be implemented and therefore the markets will then rally because then at least we know what action is being taken. So two different worlds, essentially. It depends if you're in it or not.
I know, people are really battling to get traction because what looks like a headline that a couple of months ago would have led to a big sell-off seems today not to be a worry and things are starting to move to the north. But I guess if you stand back and look at it, what we know is that the European mechanism for dealing with these things has been voted into place. We know that the debates are shifting towards greater degree of political and fiscal union. And we know that there's a kind of recognition that the design flaw in the euro with the banks and the insurers is being acknowledged and taken care of. So I know that encompasses a lot of things, but I think it's fair enough that people are feeling a little bit more optimistic about the eurozone and its issues than a few weeks ago. Although it is worth noting that the scale of the banking sector in Europe is very big. The scale of its outstanding assets, remember a bank's asset or its loans are very big. I don't know quite why that is, but this is a much more complex problem to solve than the US banking crisis back in 2008, because there you had one Fed, one set of banks, one set of political actors. Here it's much more complicated.
We talk of these European banks, and actually banks in Greece in particular were down around 15% today, while banks in the rest of Europe were actually enjoying gains. And again, this haircut that we're talking about 60% haircuts, it's insane what is actually going on. And then your comrade, Sasha Narishkin, a little earlier today, was telling me about how China is importing Greece essentially in 1 year. So the numbers that we're looking at are relative. You've got to compare.
I heard him saying that, and I do agree with him, and it does sound quite good to say that China imports one Greece every year, so what's the issue? But we know that it is real. It's real for people in Greece, and it's real for everyone that's owning those Greek bonds. But I'm still of the group that says, I'll wait and see. I'll still see if there's going to be a major credit event here. Because people talk about haircut this and haircut that, and the next thing, a plan is being made in order to kind of solve the problem, and then Greek tax revenues are rising and so on. So I might be in a minority of one here, but I don't think there's going to be a Greek explosion and economic collapse in that country. I think you might surprise ourselves by squeaking out of this one.
Okay, and we've got the medium-term budget policy statement.
Who? South Africa?
Tomorrow, Paul, tomorrow.
Yes,
Stop
yes,
looking at those caterpillar numbers and US earnings. We live in South Africa, in Africa.
No, it's true. The occasional local economic release does have an impact on our market, less than you'd think. But yes, we all are waiting to see what the fiscal deficit looks like, what the GDP forecast is, and what tax collections look like. I think most people are expecting it to look a little bit grim. But, you know, again, we know the way it works down here. Only 3 people know what the fiscal balances are, and they're all on target, apparently.